Unlike most retail traders, I use a special chart, order flow charts. They don't simply show you price candlesticks, they actually shows you the interaction between buyers and sellers. We are watching the interaction between buyers and sellers. You can see the buyers protecting this horizontal area of 24,800 and the sellers protecting the area of 24,825 to 26. This interaction is what we can actually see from price action. So in this case, what a price action trader will do is will typically wait for the breakout of this level to understand a continuation in structure. What you don't have is the actual interaction of orders. To see this and to get an advantage over the other traders, you can activate the order flow values that is giving you a breakdown of the delta and the total volume. In this case, you can see that buyers got really aggressive on the top, but they didn't manage to break through. So you can see that here they are being absorbed really heavy by the sellers. But in this case, you can see that 599 of delta in a total volume of 2,800 and 332 tried to do the same from the low part and got absorbed. So when you have this case punched to the wall by the sellers with absorption and a huge aggression of the buyers, because you can see an all-time high on volume, 4,600 with 812 of delta, what you can expect is that the next move will give you a breakout. And this is a way to get an informational advantage over the price action traders.
Okay, so now we wait.
We wait for the other setup that will be probably at the absorption of these sellers. I want to see a whipsaw here. Whipsaw is when you see a fail. It's probably a failed auction.
Okay.
It did the, but it did too much. No. Okay, they got it.
Order filled.
Auctioning high.
Order
Auctioning
filled.
high. I want to be also with another position on this low and another position on this low. Now, we want to be liquidated, and we are happy to be liquidated if we go below this low. Just where it's more smart to build position, we are absorbing the aggressive
Order
sellers.
filled.
So one here and one, no, one here and one here.
Order filled.
Anyway, okay, so this is the situation at the moment. This one was confirmed by this failed auction with aggressive sellers. If they breach through this level, I'm happy to take a stop loss. In the first month, I have 50% profit. In the second month, I start from 0.25%, I raise to 0.35% or 0.40%. But if I get a good day, 1 to 4, 1 to 3, 1 to 5, multiple trades per day, maybe I sit at 5% profit for the day. So I take half of it and I risk in through 2 or 3 trades. And if I'm risking, for example, let's say 2.5%, 2% on one trade, and I get a 1 to 5, it's 10% on the account.
Right.
But this 10% is compounding with the additional 50% of profit. So it's way more. This way I keep my drawdown really low, but low, I mean below 20%. But to achieve 218% in 3 months, it's more than 1 to 10 risk to return in the concept of risk. So it's really big. I was trading like this 3 years ago. Then I did a statistical analysis on the MAA, that is maximum adverse excursion on price, and is the number of days during the month that you have really big explosive moves.
Okay.
And it's not so big in percentage. So I just want to compound smaller profit, but every day, instead of taking the home run, 1 to 10, 1 to 15. This is another thing that I think it's a misconception in the trading field. People think that 1 to 1 and 1 to 2 risk to reward are really bad. They just want to shoot for 1 to 30, 1 to 40, 1 to 30. Maybe you will get it, but my priority is win rate. I want to see a lot of profit in my trading account, not only one profit and then a streak of 10 stop loss.
Dynamic risk management. What does it mean? That I classify my setup from A to C. A setup, B setup, C setup. Not all the trades use the same risk. So if I get, for example, a C setup, I will risk 1,000 euros, maximum 1,500 as a stop loss of risk. If I get a B setup, it can go maximum 2,000 euros. If I get A setup, that means that all my confluence step in. I have the most statistical hedge that I can find in the market in the Nasdaq, so I will risk maximum 2,500 to 3,000. We will use this risk management for today, and we will try to build the profit for the day to then increase the risk during the day. So we will start really low and chill. It seems to be starting to create an A setup. What I want to see is absorption there. And I already see that the market is developing really good because we have a bullish bias for the day, and we start to see that the market is presenting some absorption here. So the sellers are pushing, we are reaching our point of interest, but I want to see some kind of buyers to step in on this level that right now is not happening. We can only see the sellers pushing. This is the benefit of order flow. You can see all this aggression in price. This, for reference, is the profile footprint. It's not the bid and ask. So because I want to see exactly what is happening at each level. The reason it's really important to have a trigger that is giving you some kind of edge in the level, because this was an area of interest that I will use for searching for buy opportunities, but the buyers didn't step in at this level. So I will just wait to see if there is some kind of absorption here. But for the moment, we just wait. This is the most important skill for a scalper.
What's PAA?
Potential accumulation area. Just a level that I get from structure, because you need to start the day with the narratives. So this was my level of interest to continue higher, but for how the session is developing, we are not yet in New York session, I think we can search for one short opportunity when we will get back to this level here. So again, now it's a waiting game.
Yeah.
So even the scalper needs to have a little bit of patience.
How would you do this without the bubbles?
I cannot.
Like, it's so clear.
It's so clear.
With the bubbles, you can see the aggressive buyers and sellers that matters. This is better than the footprint.
That's the reason with time I understood that filtering by quantity of orders is way more clear.
So much more clear.
So
it's
much
like
more.
having the deep map on the chart.
Exactly.
It's perfect.
When you remove the price action and deep dive, you can see that the lowest volume of interaction in all the area of value area, so where 70% of the volume got transacted, is exactly this one. It's the level that goes from 24,318 to 24,317. It's a small level. It's not even an area, okay? This is what actually in all this range and in this value area, it's the fair value gap. It's where the volume didn't transacted in a balanced way. And what you will see thousands of times is that this is exactly where the price will reject. So I strongly advise you to implement this concept, even if you are a price action trader, because you can get more precise, more sharp, and save a lot of headache trying to find the correct area. I will start with my process of creating a narrative for the day with trading. So the first thing is that the analogy of the car is that the price structure, because I still use price action, because the price action is the result of the impact of the volume. So it's really important to understand if for the day you are like aggressive buyer or aggressive sellers, and you can see only from the result of the volume, and the result of the volume is price. If I see that I'm, for example, going long really aggressive and accepting different structure, breaking structure high, like the concept of market structure or auction market theory for volume traders, to create, this is the first step. This is the direction of the car. Then I need to check the order flow. The order flow is how much they are putting the feet on the gas, how much they are pushing. And this for me is order flow analysis. Order flow analysis is my trigger. It's like my execution model. So for example, let's say that I'm long for the day and I see a retracement in price, and the price reach a really important level for me. Point of interest is called in the price action world. And on that point of interest, I'm not immediately opening the trade. I don't trade on limit orders. I just wait and I see if from the order flow I can see an aggression in price. I want to see momentum and follow up from price.
So it's not only volume, it's the relationship between volume and price. After that, I start to trail my position. So to reply to your question, I start to follow the market with my stop loss. So if I see that the volume is continuing to rise and the price is following up, I'm following. Because if I have a break of structure, it means that there is a volume shift and I want to be out of the position. I also did a statistical analysis on this. When you have price that is rising and you have a breakout short, and this breakout short is being followed up by order flow, so the volume is going aggressive short, there is a huge probability that I will get a stop loss. So it's worth for me to take me out of the market with some profit.
Now we will go through an example of pressure. So how can we create a proxy of pressure for market participants? In this case, we are in the chart of Nasdaq, and we are in a compressed area where buyers are pushing really hard to break the level, and the market is compressing. But the first question that a trader can ask is, we will be in accumulation or we will be in distribution? We will go up or down, because it's not clear, okay? In this case, you can use volume to help you and understand the pressure of the cumulative volume delta compared to price. That's the secret. This is called volume spread analysis, so understanding the result on the price for the proxy of the volume. And I will show you an example, because here it can seem like the price wants to create a breakout, okay, wants to go down. Then it tends to be a failed auction, but a lot of traders maybe can see open candle and try the breakout and test. Why going long in this case? I will explain to you using the cumulative volume delta, that it's an amazing indicator that gives you a sense of the pressure of the market. And in this case, you can see that we have a lower low on the cumulative volume delta here, while the market is still on the same level as before. This is what it's called absorption, okay? So there are passive buyers here that are absorbing all the aggressive sellers, and the market is not willing to go down. All this candle got completely absorbed, okay? In this case, you can confirm objectively with the absorption pattern the failed auction. You can get a clear direction for the day, and you can also get trend following trades when the delta don't match with the price, because when you are in a momentum phase like this one, and you can see a huge amount of aggression following an absorption, you can understand that the buyers are in control. Okay, but how can you jump on the trend in this case? You can jump on the trend in this case using exactly the relationship between cumulative volume delta and price. I will give you an example. In this case, we have a sell candle that tried to create a lower low, but on the correspondent part we have a huge absorption. All this pressure got zero results, but you continue to see sellers trying to go down here. This is again an absorption of sellers. So it's a mismatch in price and volume. And this is a nice way to use the cumulative volume delta to create a proxy and to confirm your trade with a high probability of being right.